Hello, everyone. Good morning, good afternoon, depending on where you're joining us from. Today, we are diving into tax compliance strategies to help you reduce risk and save time. My name is Courtney. I'll be your moderator for our session today. And today, we're going to be covering ways that your business can not only reduce its risk profile, but also streamline your business operations. Before we dive into the content, though, just a couple of housekeeping items from me. First and foremost, if you've attended any of our webinars in the past, you know that we always record them and share that link with you later. So we're doing the same thing today. So if you want to listen to the webinar again or even share it with a colleague, you will receive the link to that within the next 24 hours. So keep an eye on your email inboxes for that. And then speaking of, this console that we're looking at, this orange webinar console can be completely customized. So these windows that you see appearing on that screen, you can move them around or resize them to your liking. And then speaking of windows, just a couple that I wanted to call out for you. So over on the right-hand side to the right of the slides, we have some additional resources and links for you to check out. So if you'd like to learn more about any of the topics that we're discussing today, you'll see some available links. And then that's also where you can download your own copy of today's presentation. So if you'd like to save the slides for later or just use them to follow along today, you can download them in the additional resources section. And then there are also several ways that you can engage with us, with both presenters and other attendees that I wanted to call out. So over on the left-hand side of your console, you'll see the Ask a Question box, and that's where you can submit any questions that you have for myself or our speakers. That's where you can also, if you're having some troubleshooting issues, you are welcome to submit your questions in that Q&A box, and we'll do our best to support you there. And then if you're interested in speaking with some other attendees from today's event, other tax professionals like you, there is an icon at the bottom of your screen with two chat bubbles. It looks like text messages. So click on that, and there is an attendee chat box that will appear on the console, and that's where you can network with your peers. So we'd encourage you to open that box if you're interested, introduce yourself, let people know where you're joining in from, and then you have the option of keeping that window open or closed throughout the presentation. And then third, you can also react to the topics we're covering today by clicking on the emoji icon and reacting in that way. So we'll see them float across the screen, which I think is always fun. And then just a quick note, if you have any technical issues, there is a question mark icon down at the bottom of the console. So you can click on that and see some answers to frequently asked questions there. All right, friendly reminder, our legal team always likes us to mention that at Avalara, we cannot provide legal tax advice. So all of the information that you see here is for educational and informational purposes only. But as always, when it comes to answering your questions, we'll do our best to be as thorough as we can. And then I also wanted to remind everyone, we're offering 1 hour of CPE credit for today's presentation. There are 2 requirements to qualify for CPE. One of them, you'll need to respond to 3 out of the 4 poll questions that we'll have appearing throughout the presentation. And then you'll also need to attend for at least 50 minutes, that's 50 minutes of today's session. Once you have met both of those requirements, your certificate will be available to download in the Earn Certification box on your screen. And then we will also send out a link to your certificate in the post-event email. So if you forget to download it today, don't worry, it's not gone forever. And then a quick shameless plug, Avalara Crush, our customer conference, is coming back in November in Austin, Texas this year. It's November 11th through 14th. That conference is designed to help you get the most out of your Avalara solution. So it's really geared toward current Avalara customers. But there are also ways to gain insights on industry trends and meet with your peers and other tax experts. We just added some new sessions to the agenda. So if you like today's webinar, be sure to check it out over at avalaracrush.com, and that's also where you can register. All right, enough from me. Let's dive in and meet our presenters. So first up, we have Stephen Cabrera with us. So Stephen is a tax director at Avalara. Stephen, let me pass it over to you and give you a minute to introduce yourself.
Sure, thank you, Courtney. So yes, admittedly, I was a sales tax auditor for the state of California for a number of years, and I did a lot of different industries and then went on to Big Four, Deloitte, RSM, Grant Thornton, and engaged in many different areas in the state and local tax practice, primarily sales and use tax. And now I'm at Avalara. I'm happily focused just on 2 areas, which is Nexus, and then helping our clients get out of some huge tax liabilities through volunteer disclosure programs.
Awesome. Thanks for being here, Stephen. Excited to hear from you in a little bit. And then we also have Christine Martin joining us. And Christine is a senior solutions consultant at Avalara. So Christine, you want to take a minute to introduce yourself as well?
Absolutely. Thanks, everybody. I actually was a tax manager at several companies in industry. And not only was I responsible for the transaction tax piece, but also things like annual reports and unclaimed property and property tax. So I've got this breadth of knowledge from multiple industries, just like Stephen, whether that's lodging, transaction taxes in communications taxes, and manufacturing as well. So my job here at Avalara is working with our customers, our prospective customers, and helping them put technology together to solve their issues with transaction taxes.
Great. Well, thank you both. Really excited to have you here and kind of dig into some of your past experiences with audits in the past. So let me do a quick rundown of our agenda today. So first off, we're going to start off with going through what are some of the risks of getting tax compliance wrong. We all know that tax compliance isn't going to bring your business any revenue, but you need to come in prepared with some of the things that can go wrong with it. Then we're going to dive into 3 common areas of audit focus. So if your business is to get audited, what are the 3 areas that the auditors are going to be looking at first? Then we'll also highlight some other areas of notable risk and compliance, things that you need to be aware of. And then finally, we'll close out with some solutions that you can keep in mind for minimizing your risk before we dive into Q&A at the end. So with that, Stephen, I'm going to pass it over to you to dive into the risks of getting tax compliance wrong.
Okay. So we look at it as it's a non-generating activity, but if anything, it's a costly activity because it's not only that you're going to have to pay the tax if you're assessed, because sometimes the misconception is, well, I didn't collect the tax, so I don't owe the tax. So, yeah, I'll go ahead and admit I did wrong, but let's just move forward, and that's not how it works. The state expects tax revenues. If the sale was subject to tax, somebody's got to pay the tax, the way I put it. And so the cost coming in that if you get audited, you would get hit with that tax liability. Those companies that hold Nexus are responsible to collect the tax and remit it to the state. They can go back and get the tax from their customer. Often that may not be feasible. Sometimes it is, sometimes it isn't, but nonetheless, it's going to be a confirmed cost for you. Operational resources and time spent are kind of going together. I mean, how much time are you going to spend preparing your tax returns? And really, it's a balance between, if you're going to do this very manually, trying to find the most efficient way, but getting to the right answer, or using automation to shorten that time and put the computer to do all the work. So the time spent is really dependent upon how you take your books and records, and really it all begins at the transaction level, and find a way to get those numbers to the tax return, and that's time spent. So you may want to consider how much time you're spending, if there's any ways to streamline that. Then you have employee turnover. Many of the calls I take every day in this area for, Nexus and things, is I hear that, well, yeah, I just started the company 3 months ago, and I came into this big situation where I'm seeing a lot of, I know something about sales tax. I don't think they let it go, and there was turnover. And so often, or there is a complete due diligence, people are trying to do the right thing, but if the predecessor didn't train the new person coming in or gave them some limited guidance, then that's where things can go wrong there with employee turnover. And all these things lead to potentially getting audited, which kind of circles back to what I said, is that the liability in of itself, tax, interest, and penalties, could be quite costly, or maybe you'll come out with a fairly small tax bill, or maybe it'll be a no change, which means nothing was found. So it really comes down to what we'll be talking about is risk of getting audited, risk of not doing things right, and how is this going to impact your business?
And I want to jump in real quick and talk about the audit piece, because I think we've seen, and Stephen, correct me if I'm wrong, there has been an increase in audit activity because of this economic nexus wave, if you will, of states hiring more auditors and hiring more auditors in states outside of where they are.
Yes. Yeah, I can touch upon that. So, for example, in California, my home state, California has offices in New York, Houston, and one more state. I can't remember. It's three different
Florida.
locations strategically. Florida. Thank you. For sending those auditors into other states outside of California, because those out-of-state companies have nexus in California. So it's a lot easier to send them from different places. And with the economic nexus that came out about, we're going on 6 years, a lot of companies are not aware of it, taken by surprise, and they are complicated, the economic. We're going to talk about that in a minute. So, coupled with the fact that states are hungry for tax revenues and they're forming task force, so they may just name them as the economic activity, economic nexus. Maybe that's going to be their focus. Yet they're going to check all other areas of audits that they do, but they could form campaigns and things because it is a complicated way, and they're already anticipated there's going to be lost revenues, and so there would be increase in staffing.
I had worked with somebody that worked for the Georgia Department of Revenue, and their supervisor said, I want you to look at the newspaper and figure out who's having garage sales week after week after week, and show up and ask them where their sales tax is, because they weren't occasional sellers. So to your point of these task force and other programs, it was looking at garage sales.
Yeah. And you would think they're really getting down to the pennies. That's how hungry they are. They're going to go after people selling things that are used, which can still be subject to tax. And people say, well, I already paid tax on them. They can't tax it twice. And that's not correct. There are certain rules where could be some skirting around, and then some where no, it's taxes due again.
Interesting. All right. Well, before we dive into economic nexus and other types of nexus a little bit more, we have our first poll question available on the screen. So for this first one, we're interested in having you pick one. What is the single most important aspect of tax compliance risk management for your business if you had to pick only one? Is it keeping costs low and reducing your time spent on tax compliance, optimizing your operational efficiencies, minimizing your large audit liabilities, or reducing the overpayment of tax? And we'll leave this up for a few seconds and give folks time to respond.
I think D is kind of an interesting one, because nobody wants to underpay, but you also don't want to overpay too. So that's always an interesting one, to make sure that you're not paying too much.
Yeah, and while we're giving folks a few seconds to respond, can you talk a little bit more about that? What does it look like to overpay, and what happens when you do?
I'll give you an experience from when I was in industry. Is we had actually put something in place for accounts payable, and we didn't really train people too well on it. And one of the questions that popped up when they were processing an invoice was, did the vendor charge tax, or do you want to accrue tax? And our accounts payable people just said, yes, yes, yes. And the first month after we rolled out this program, the amount of consumer use tax that we owed was huge. So we had to go back and request refunds for overpayments, which is a pain in and of itself. And we had to readdress this program that we put in place because it wasn't working the way we were expecting.
Interesting. All right. Well, let's move on and take a look at our poll results here. So let me scroll through these. It looks like almost 30% said keeping costs low and reducing time spent is the single most important aspect. Optimizing operational efficiency is number 2. And actually, I misspoke. Minimizing the large audit liabilities is the number 1. So I didn't realize that I hadn't scrolled down enough. So interesting call outs. I think no one, to your point, Christine, no one wants to have those single large audit penalties that are slapped onto their business, even if they are overpaying. So thanks, everyone.
Interesting how close those top 3 are.
Mm-hmm. Very, very. So I think they're all important to businesses that are here today. So thanks, everyone, for responding to those poll questions. I'm going to pass it back over to Stephen to dive into a little bit more about Nexus and what you need to know there.
I'll put it kind of in my own words, and it depends on your business model. And Nexus does not necessarily mean you have a tax liability. It means you have a filing obligation. in most cases, in many most cases. There are some minor exceptions. I always like to be kind of literal about that. So you define the level of your connection. How close your connection depends upon how you do business in the state, how much you're selling into the state. You'd be surprised. There's many different ways to create nexus. So we're going to get into that now, but until that connection is established, you're not required to collect sales tax. Now, you can. States love it. I always say that states love it. If you collect sales tax, you don't have to. They're perfectly fine with that because it helps ensure that even though the retailer wasn't required to collect it, that tax is still getting to the state. So this goes to where I was saying there's many different, we're going to be focusing mainly on physical nexus and economic nexus. But as you can see, there's other forms of nexus that you could either speak to a tax advisor to see if you fit into that, do your own research, but be aware that there are many different ways to create nexus. And so what I'll do is, rather than talk too much on this slide, I'm going to show you some slides that actually get into physical nexus and economic nexus. But this is kind of give you a big picture of the different types of nexus that you may fall into that you may not know you are falling into. So first we'll start off with economic nexus. We'll talk about physical nexus in just a minute. So as you can see, they made it very complicated. In 2018, when the Supreme Court decided the Wayfair case, and every single state that has a sales tax has adopted over the years, beginning in 2018, a lot of them in 2019, 2020. Missouri was the last one in January of 2023 to adopt it. So then what they did, well, let's come up with different thresholds. So as you can see in this map, let me give you a few examples. I'm going to do my home state, California. So California says if you go over $500,000 and you make sales of tangible personal property, now mind you, it's just tangible personal property, nothing else. You may be a SaaS provider or a service provider. You don't have economic nexus in California because you don't make sales of, if you don't make sales of tangible personal property, that revenue stream is only based upon $500,000, could be taxable or exempt. However, you come over to Florida on the other side, over there in that state, they only count sales of tangible personal property that's taxable. And so now you've narrowed it down even further, $100,000 in a calendar year. California's 500, but now you look at Texas right in the middle. Texas counts everything, no matter what product you sell, and no matter if it's taxable or exempt. That's often the misconception, is sometimes people think that only taxable sales count towards the threshold. That's true in Florida and a few other states, but not necessarily other. And then, so you have to be careful about how you look at this. And I believe the next slide is going to get into that a little bit more. But this slide really highlights the different levels of the thresholds that have been set forth.
I find it interesting that California and Florida have specifically said it's tangible personal property, where Texas is like, hey, whatever you sell, that goes into this equation. And because it would be silly if every state did the same thing. So it's so nuanced that I think sometimes we forget about how nuanced it is.
Exactly. And so I take these calls every day, and some of our customers are pretty savvy. They've done their homework and they suspect, but this is what I do for my profession, is sales tax. Who has time, if you're not doing what I do, to spend studying all of this, these intricate things that could make a big difference in not knowing that you have nexus and accumulating a large liability. Of course, if you sell into a state that's nothing, it's all exempt, well, at least the impact really isn't that great. You didn't file some returns, but you don't owe any tax. So that may not be the same thing in every single state, because sales tax does vary in its taxability among the states as far as what you sell. We have a slide on that as well that's coming up. So we just went through the dollar thresholds. Now let's look at what's kind of going on with what's being sold. I threw California as an example for, it's only tangible personal property, but they don't actually include any type of services, any type of electronically downloaded software. we told you that Texas does include exempt sales. And so different states they'll say, hey, we're going to include tangible personal property and taxable services, but nothing else. Other states will say, well, we're going to include taxable services and tangible personal property and nothing else. And you got the states that include everything. So digital might be excluded in one state. Software as a service could be excluded in a state when everything else. The distinctions are tangible personal property, exempt services, taxable services, another category, digital, software as a service. They each have their combination that if it's within the state, it could be any combination thereof, or they're just simply going to include all of it. As you know, there's about 5 states in the U.S. that do not administer sales tax. So we have listed here. So no sales tax, no economic nexus or physical nexus, of course, because that only applies to states that assess tax. Physical nexus. I'll tell you, this has been around for many, many years. And I'll tell you this, I find this much more important than economic nexus. And the reason I say that is because there is no dollar threshold to meet. You don't mix the two, where if you have, let's say, if you look over to the third row and the third where it says commissions, that's a big one. Commissions to resellers, 1099s. Often the misconception is, I don't have employees going in there. Well, if you have 1099, it's not a payroll tax matter we're talking about. We're talking about sales tax. And the states say if you send anybody into our state to do things for business reasons, you have physical nexus. There is no dollar threshold. A long-term phrase, it's called boots on the ground, which simply means you're sending people in there to do something. And it includes employees or subcontractors. So keep that in mind. That is in the statutes for enforcement. Because that way the states was saying, well, we don't want anybody just sending in contractors. If they don't hold the contractors responsible, that certain companies could say, well, I'm not going to send any my employees. I'll just send all 1099. They could skirt around it. But it's really never been that way for as long as I've been around. Maybe it was that way before and they revised them. But at least in the last 20 some years, it's been that way. So maintaining inventory in the far right corner, you can see inventory. My point to you is that let's say you never go into the state. Okay, fine. I'm not going to send anybody in the state, but I have inventory there. It may not even be my warehouse. You use a 3PL. Somebody else is picking and packing. The inventory in of itself creates nexus. So just keep in mind that it's not necessarily just your people going in. You don't have people in there. Tangible personal property that could include rentals. Now, I know this is not a lecture really on completely the deep dive of Nexus, but as you look at this, you can see that there's a number of things that can create physical nexus. And so it's very, very important that you know them and not make any type of presumptions. There are, various guides. There's tax advisors like ourselves that I do this every day, other tax advisors, but it's always important to know when you're doing multi-state sales, you're talking about you're opening yourselves up to 46 jurisdictions that could have an impact, depending on how large you are.
The maintaining inventory one is really important, especially as we look at marketplaces now, right? Like Fulfilled by Amazon. That means your products are sitting in an Amazon warehouse that can be moved anywhere to any Amazon warehouse, giving you nexus then, right?
Yes, and that's a very good one. Often people will tell me on calls, well, they collect the tax. I don't need to worry about that. That's true. The sales that are made on Amazon platform, they do collect the tax. But at the same time, Amazon, when they place your merchandise, I get it. You don't have control of where that merchandise is placed. They put it into a state like Tennessee. Let's presume that there is a warehouse. There's 36 states at the last count. There may be more now where they have warehouses. And I'm going to make this up because I don't have it memorized in my head, but let's say that Tennessee, they take your merchandise and it's there. It's going in and out through the sales. Well, the state says if that happens, the e-commerce portion of your company, you need to be collecting sales tax. If you're making separate sales out of your own website, you need to be collecting sales tax from your Tennessee customers or made directly from your website. for shipments into Tennessee because Amazon created Physical Nexus for you. You do have access to reports in Seller Central that you can run to see where is Amazon placing, because from what I know so far, they don't send you notices where they're sending it. You have the access to run those reports, and that's a very big misconception that I hear. Some of you know this, and a lot of you could say that's fine. I didn't presume it, but there are quite a few that didn't think, because it's kind of misleading, sales tax being collected by Amazon. So be very aware of that, because most states, there's a couple of exceptional states that won't apply, but pretty much I'd say 80% of the rules apply to every single state. They want their money. It comes down to how hungry the state is for tax revenues.
All right, well, we have our second CPE poll question appearing on your screen. So for this one, we want to know, Stephen just talked about Nexus. So in how many states does your business have Nexus? 1 to 10, 11 through 20, 21 plus, and if you don't know, that's okay too. Maybe take your best guess. Again, while we wait, I've had a couple of questions that came in while we were talking about Nexus. A couple of them were related to representatives and kind of 1099. So one of them says, what if you have representatives you pay commissions to, but you don't have a 1099 with that company? Any thoughts on that one?
What was that question again?
Yeah, let me read it again. What if you have representatives you pay commissions to, but you don't have a 1099 with that company? So it sounds like they're paying commissions to an individual, but there's no 1099. Does Nexus still apply there? Physical presence?
I'll give you my answer, and Stephen, correct me if I'm wrong, but my answer is always, it depends. One, it depends on the state, and two, that relationship with the company or person that's in there.
Fully agree. There's always it depends. I would say that but the depends is probably going to lean more towards that. Yes, it will create physical nexus. I look at, is there a contract, or is there any type of compensation, some sort of formal arrangement between the company and this individual representative? The states use broad terms like agents, representatives, canvassers, salespeople. Call them what you want. Call them anything you want to call them. Ambassadors, I've seen that term, right? But if you're compensating that person, and sometimes there's an agreement, sometimes it's a verbal, hey, I'll pay you if you do this, the state more than likely, with that depends variable, is going to say you have in-state representation, even if they're not a 1099 or not. Okay. But as Christine said, could be some exceptions. Yeah, but not very many, I would imagine.
Yeah, those people are out building a market for your business, yes. Right?
Yeah. Okay, thank you for clarifying. And then one more quick one, maybe if we can provide a quick answer, related to contractors and commissions again. So they have an out-of-state contractor on 1099 who's getting paid for services, but not for commissions. Does that still create physical nexus?
Yes. So that contractor, again, is they're contractually fulfilling the work. So I think what I'm hearing is that if there's a contractor performing services for the company, they're being compensated, then yes, because it's like having an employee doing, if you send an employee, I think everybody gets here, okay, I get it, send an employee there to do it. But the contractors could be doing the same exact work, theoretically. If you replace an employee with a contractor, the state's going to say, okay, fine, we still don't care. You sent somebody in to do work. They're not your employee. They're not a related company. It's a person that's doing the work. Yeah. And they don't have to be a 1099, or they could be a 1099.
Got it. Okay, thank you both. All right, let's take a quick look at the results here. So more than half of the attendees today said that their businesses are or have created Nexus in more than 21 states, which is a good chunk. Another quarter said 1 to 10. And then we have a spattering in 11 to 20 or I don't know. But I think that's pretty telling. When you have Nexus in so many states, you really have to pay attention to some of the risks that go into each one of those states and what that means for your business. So again, thanks everyone for responding. And let's go into the 3 common areas of audit focus. And Christine, I'll let you dive in here.
Thanks. That I don't know may have come up after all of Stephen's conversation about what's creating Nexus. Maybe we've added some thought in there that people are like,
Yes.
I really don't know anymore. So let's talk about the 3 common areas of an auditor. So mostly they're looking at tax determination. And if we think about this broadly, every transaction is considered taxable unless you can prove otherwise. Well, what does that mean unless you prove otherwise? Well, if we think on the exemption side, it's an exempt piece of paper, something that says, don't charge me tax because. So if an auditor looks at all of your sales and says, wait, there's no tax on this, why didn't you charge tax? You've got to find that one piece of paper to say, I didn't charge them tax because look, they told me that they're going to resell it, or they're a government agency. So that one missing exemption certificate could have some pretty bold impacts on an audit itself. But another piece on why tax may not have been charged on something are one of these sales tax holidays. And usually they go around schools, or Florida's got the hurricane preparedness tax holidays. So maybe you didn't charge tax because it fell within a tax holiday. And there's a whole bunch of states that have these tax holidays that allow for the purchase of items to be tax-free for a window of time. Maybe it's a weekend, maybe it's a week or so. And if we look at since 2023, there was 98,000 tax holiday rules that were updated. And I think about when I first started my career in tax, I can't imagine trying to do this manually and saying, these items fall into it and turn it off and then turn it back on when that holiday is over. But also this other piece comes to your customers. When you're shipping things or providing a service at a customer's location, you've got to know how, one, what you're selling, how it's categorized, and how it's taxed on where you're providing that service or where you're shipping to. And that kind of goes to that Nexus piece too. Do I have Nexus? And if I do, how is this item or service taxed? And that goes to that taxability determination piece. And we can keep going through this one about taxability determination, because that's really what the auditors are spending an awful lot of their time on. And one thing that I think most companies struggle with, especially the larger ones, is on this consumer use tax piece, and whether or not you owe consumer use tax on your purchases or on the movement of assets. I had an auditor, we had actually just opened a new office and we had moved it. And an auditor came in and he said, oh, this is nice furniture. I know that you guys just moved. Is this new furniture? And our receptionist said, oh no, this is furniture that we brought from our other location. Well, we happened to move jurisdictions. So one of the questions that that auditor had for me was, did you pay consumer use tax in our jurisdiction now for the movement of these assets? Because the tax rate in this new jurisdiction was higher. So they're looking for these types of things and whether or not they're taxable. This consumer use tax piece really becomes complicated. I think of when I worked for a manufacturer and we would buy a forklift. And when is a forklift not a forklift? Well, when that forklift is part of the manufacturing process. But then you have to understand, when does the manufacturing process begin? So understanding those things and helping the auditor sometimes even understand those things as well. So auditors are doing tests. They may take a sample of transactions and running it through maybe a program they have, or maybe they're using Excel and they're coming up with their own determination and comparing it to what you've already done. And that may be what the assessment is based on their determination and their interpretation of the tax law.
If I may add, I'll tell you what I used to do. And after leaving state service, then I defended clients in audits as well at the large accounting firms. And so what I would do when I was the auditor, I would ask you for your federal income tax return depreciation schedule. That's going to show me the capital assets the company has purchased. Then I would ask for, okay, show me the purchase invoices that go with these capital assets that you're depreciating. You know, it could be furniture, computers, equipment, things that they bought that for their own company use. I see the invoices and I don't see any tax on them. Then I would say, okay, did you report your use tax on these purchases? It's a very straightforward test. No, I did not. Okay, I've got to schedule it in and they owe use tax. Or to Christine's point where I see it and somehow I found out that it was brought over from another jurisdiction. Yes, you could write up the differential for the higher tax if the place where they're at now is a higher tax rate than lower, then no problem. But those are the things that the auditors can do. It's a very straightforward. They're usually they have jurisdictional rights to ask for federal income tax returns because they do play into a sales tax audit. They use the federal income tax returns to see that do gross receipts match somewhat the sales tax gross receipts. There could be some differences that are legitimate where I'm not an income tax person by any means, where the gross receipts could differ. Well, explain it. Why are they different? But back to the use tax, there are tests. If there's way too many tests, then the sample is what Christine had mentioned, where they could easily do a test, extrapolate things. So make sure that when you buy something from out of state and you know it's subject to tax, make sure you report the use tax on it. If the retailer does not collect the tax from you, because it's an easy test for an auditor to perceive that in that manner.
I think about an income tax. I mean, us personally, if you use a popular income tax program, one of the questions is, did you buy anything online that you didn't pay tax on? And really what they're looking for you to do on your state income tax return is pay that consumer use tax on things that you bought personally. It's that same concept for business, except they're not asking it on your income tax return. They're expecting businesses to know that they've purchased something that tax wasn't applied to, that they then owe it. Let's talk about the tax rate accuracy. That's one of the things that auditors look at as well. And again, it would be silly if every state had the same rate. Then Stephen and I wouldn't have had jobs for as long as we have doing just transaction taxes. But the sales tax rate and the use tax rates and the accuracy of those rates are important. I think of states like Missouri and Arizona that have a different sales tax rate from a use tax rate. Illinois used to have a different rate for sales tax and seller's use as well. So being able to keep track of those things, because that's one of the things the auditor is going to look at. They're going to do their calculation, compare it to your calculation. What's that difference? Was it a tax rate difference that caused those problems? And keep in mind that there are some things that are taxed differently. Again, I go back to Illinois. Illinois has more than one sales tax rate. They have a reduced rate for medical items. They've got a standard rate for just tangible personal property, but if it's a medical item, it's a different tax rate. So there are an awful lot of states that have more than one sales tax rate, but it's depending on what it is that is being sold and or purchased as well, too, because this tax rate accuracy is more than just the sales tax side. It also applies that you should know, based on what you're purchasing, what that accurate tax rate is based on where it's being consumed, not necessarily where the bill is sent or where the bill is processed, but where it's actually being consumed. And I mean, if we think about just in sales tax world, there's over 13,000 tax jurisdictions. If you're in telecommunications or in lodging, I would almost double the number of taxing jurisdictions and tax rates in those industries as well, because there's so many different things that are taxed and at different rates. And that really becomes the challenge of this, which is one, understanding nexus. And then once you've understood nexus is how do I tax and how do I apply the rules and the rates to all those things that I'm selling?
I did want to add, when you said the word consumed, you're talking about where the good was received. And I know you meant also where they service. So I want to reiterate that if you're a service provider and you contract you're in one state, you're in state A, your customer's in state B. Remember, the consumption is if you're providing a service, and let's say you're doing it in your own state to compile something, and then you sell it, and the beneficiary, the consumer, is in state B. You need to count that as state B sale, even though you actually could have performed the service in state A. Is where is the benefit of the service received?
Yeah.
That's considered consumption. So I just
Oh,
want to
that's
make
a
sure
great point. Yeah, that's a really good point, that where the benefit is received, especially for software, right? That's a great point.
exactly what you said, and then put a little spin on it. What if company B says, well, my billing's in state C? Well, sure, you send the bill to state C, but because the benefit of the service was received in state B, you would still count that as a state B sale. So always treat sales tax as destination based, not on billing, but where the benefit of the good is received.
That brings up a whole other point that we haven't talked about, which is multiple points of use, especially when it comes for software, right? You may use a CRM, but you've got people all over the country using that CRM. There may be multiple jurisdictions that are associated to a single bill for software.
Did you want me to mention about that, or we're good on that, right?
Oh, go ahead. Go
I'll
ahead.
just touch on it real quick. So MPU, multi-point usage certificate. Give you an example. Let's say that you bill Texas. Texas says 50% of but see, this is if your customer says, and your software is a service provider, your customer says, well, 50% of the users are here in Texas, and we've got 50% in California. Let's make it divvy it up 50-50. The Texas SaaS customer can give you a multi-point usage, right? It's multi-point. It's in Texas and California. That allows you to prorate your taxable portion of that bill. So it's $10,000 billed to the customer based in Texas. Well, 50% of that usage is going to occur in Texas and 50% is going to occur in California. You have to get that certificate where it actually says that. The customer will specify that to you. And then once you have that you have that certificate, you only have to bill tax on that 50% portion of the bill. And then you need to, again, extend into the tax rates for that state.
Oh, yeah.
California
Texas is a
doesn't
good
have
one for
that.
software. Texas
Yes.
is a good one for software with that 20% deduction.
Yes.
And this kind of leads us to this product taxability challenge. And we gave you some examples here, but I mean, California is a great one, right? In California, software isn't necessarily taxable. In Texas, it's taxable, but there's a deduction. But there's states that have some even further nuances, like bottled water in Connecticut. And it depends on where you buy it. Do you buy it at a convenience store, or do you buy it at the grocery store? Takeout in Colorado. Think about those times you've gone to a fast food restaurant and they ask you, is that for here or to go? Well, they're not necessarily asking you if it's for here or to go because of how they're going to bag it up. It may be because of the taxability of the item itself. And toothbrushes and dental floss, ice cream in Maryland. I mean, it's ice cream, right? Not necessarily. Kind of like my forklift. When is ice cream not ice cream? When is ice cream taxable and when it's not? Software as a service, and even software within Maryland and how those things are taxed. So again, it's just so amazingly complicated. And I, again, think back when I started my career when we didn't have these cloud software solutions. We spent an awful lot of time in the law library with that onion skin paper that most folks don't know about anymore, doing this research to figure out how would I categorize what it is that we're selling and how is it taxed in a state as well. And being the former auditor, I think this is a great one for you to talk about, Stephen.
Sure. So what I would do is I'd ask for a list of books and records. I'm going to rattle off a bunch of stuff here, but federal income tax returns, copies of sales invoices, purchase invoices, general ledger accounts, exemption certificates, and a few other things depending on the industry. But they look at your key general ledgers. They don't necessarily look at all of them. right? They're going to look at, first of all, of course, the sales. They're going to look at your sales tax payable account. You collected X amount of tax. It shows in your ledger that you accrued, you had this much in payable. Did you pay the state? Does it match? There's a reconciliation. Yes, you took in all this tax. Did you pay all the tax? Sometimes I'd find shortages. Sometimes I saw it was equal. Sometimes I'd even find they paid more to the state than what was there. And I would not make the presumption right off the bat that they overpaid. I'd have to come up with my own number, what they were supposed to pay the tax. But it's a very easy to see. It's called reported, recorded, recorded, reported. What you record, what did you report? There's a reconciliation. We're probably going to mention this a little bit, but since I'm saying this, do your own internal audit. Do some simple calculations. Look at your general ledgers to see if they match. That's the whole thing. Starting from the beginning, are your transactions they make to the general ledger? What are you using to support your tax returns? So those key general ledger accounts, including for the use tax, they're going to look at your capital assets. They're going to look at your supplies, go through the filing cabinet, see did you pay sales tax on your office supplies or even the consumable supplies in addition to those capital assets for the use tax test. General ledger is also going to serve as a point of reference for your exempt customers, right? They're going to pull the sales ledger and see how many the population of your resale customers probably do a random sample test, or if there's not that many, they're just going to and say, I need to see your certificates. And back in the day, I've been doing this so long, I used to get a recipe box with certificates. And of course, things have gotten more automated since then. But the general ledger does serve for the auditor to see a lot of information. And if it's missing, you don't have it, they'll extrapolate or say, well, come up with a reasonable amount that you think it is. I'll examine it and determine if it's reasonable. So when you're missing information on a general ledger, make sure it's clear, or at least if it's not clear, have some notes to be able to explain how it ties to your sales tax return. So differences in fiscal year, and that would be calendar year, fiscal. There's a way to marry all of it up. Ultimately, what the auditor's seeing, it did all those sales make it to the tax return, whether they're exempt. Some people think, well, I don't need to worry about exempt sales. Well, yeah, from a tax liability, if they're truly exempt, but you still got to be accountable for them. And the auditor's going to see, well, I want to test them. Are they truly exempt? And there's different tests for that. So they'll look at your methodology, and that's where I would say, okay, show me your tax returns. Sometimes people were really savvy and they had a worksheet attached to their tax returns. And show me methodology. How did you get to this number? You claim this much. Let's work backwards into your steps, and that's called the methodology. Are you using sales tax software? Are you doing that? I saw some times where it was actually done on green ledger paper with an adding machine. That's how long I've been. Not that many though. So that would happen. But the thing is, what's your manual compilation? What are your procedures? And then I could kind of tell, yep, you're on board. And it's like, ooh, and I would think to myself, yeah, that's where I see a mistake. So auditors are mentally taking notes, or they're writing them down to see what is the methodology, and they can pretty much tell if they're a trained auditor. There are audit manuals that the auditor is supposed to follow for consistency. So this goes back to what I said, and the way I looked at it. When all said and done, when I used to come up with my amount, does it match what you reported? And that's basically what the auditors do. And when I defended clients, I would do the same thing with them as well.
We've got about 10 minutes left, so I want to make sure that we get through all of these slides. But let's talk about the remittance piece. I mean, there's one thing to collect it, but once you've collected it, remember, you're collecting this on behalf of a jurisdiction. It's not yours to keep. And this goes to that recorded versus reported as well. Did you record $100 in sales tax payable? Did you pay $100? The worst thing that I think companies have done is they've collected $100, but they've paid $50. They don't get to keep the extra $50. It's a term called unjust enrichment, which is just bad. So make sure that once you've collected it, you're actually filing it, and that somebody is reconciling that general ledger every single month to make sure that all of the taxes that are hitting and are recorded in that general ledger are being reported. Make sure that you've got a way to be able to aggregate all of the data from all of the different systems that you may have. But I want to touch on a couple other things that are important. One of them is prepayments. And I have seen this, I've experienced when I was in industry, just because you don't get a notice from a state that says you're required to make prepayments, you're still required to make those prepayments and track it yourself. There's states like Florida that have 3 different ways of calculating what that prepayment is. Understand how to make those prepayments, when you have to make those prepayments, and how to calculate them. Probably the most important piece on here to me is handling of these tax notices. I will give you an example. We had responded to the state of New Jersey. We had provided copies of our payment history, the postmark when we were still mailing tax returns. I didn't hear back from them. I thought everything was fine. I got a phone call from our CFO asking me to come to a conference room because our corporate secretary tried to buy a house, but there was a tax lien on her for that New Jersey notice that we thought we had taken care of. So making sure that you're not just responding to them, but following up to make sure that they truly are taken care of, because those are the worst phone calls to get. So the collection, the remittance of it, the filing of them is important. There's multiple ways to file, there's multiple ways to pay, and there's certain requirements based on how much of a taxpayer you are, how much sales, how much tax you're collecting, as to whether or not you're required to make those payments electronically. So some other things to think about.
So I'll take these top 3. Taxability determination. This is kind of going back to what we said at the very beginning. Do you know if your product's taxable? We showed you a slide on those down to the very smallest of nuances. But even with those small nuances, you could even take it back to a broader scale. Software as a service is taxable in almost around half of the states, and it's not. You have variations among that. So other types of industries, services, often the misconception can be, well, they're services, they're not subject to tax. Well, there's a lot of states that tax different types of services. Could be like New Mexico taxes almost all services, Hawaii, but then you have some states that only tax some of the services and not the others. So be very aware of your taxability, because it's probably going to vary by state unless it's hard goods, which that's usually taxable unless you have an exemption certificate. We talked about the rate accuracy. Sure, you got your taxability correct, but are you charging the tax rate, proper tax rate, particularly if you're not charging enough tax on that rate if it's understated. We talked about reconciling tax accounts. It is what it is, right? You have to come up to the right amount. Make sure that you are doing your own reconciliation to make sure it's correct. If you're still not sure, you may want to engage a tax advisor to help you with an internal audit. Especially if you're already under audit, you probably need to be making sure the auditor is being fair about it. Usually, therefore, I was fair, but so anyways, reconciliation is very important.
And there's some other things to think about too. The licenses and registrations. And Stephen, I think you've heard this a whole bunch where people have said, hey, I've collected this tax, but we didn't register. What do I do now? So make sure that you've got your registrations in line, that your business license is. And it may be more than just a business license. It may be a sign license or a sprinkler license. Make sure that you've got all of those in place as well. Being able to do tax research. Keep in mind, you can call the state and ask a question, but they are not bound by the answers that they give you. You could call back and talk to somebody else and get a completely different answer. Now what do? You got 2 different answers. Make sure that you've got some place that you can do that tax research. For me, it was, hey, we're going to buy a new airplane. Here's the parameters of where we want to put this plane. Where's the most tax beneficial place for me to put this airplane? I didn't have a tax research tool at that time. So having a tax research tool at your fingertips certainly helps you, especially when it comes to an audit and defending an audit. I briefly talked about combining this disparate systems. One, how are you gathering all of this information from all of those systems, whether it's a point of sale system, e-commerce systems, multiple ERPs, being able to pull those together. And one that I've heard a ton of lately has been mergers and acquisitions. There is so much impact on mergers and acquisitions, whether it's a bulk sales tax liability or new exemption certificates or new registrations and final returns, please make sure that you engage with somebody around mergers and acquisitions, because there is so much involved from a transaction tax perspective that can really create some issues for folks.
All right, well, we are getting close on time here, so we'll keep this third poll question brief. For this third CPE poll question, has your business ever been audited? And we have a few different results. So yes, you've been audited and had a positive outcome. Yes, you've been audited and maybe had a negative outcome. And we'll let you be the you determine the definition of what negative and positive mean there. Maybe you're currently underway with an audit, or maybe your business hasn't been audited yet. So we'll leave this up just for a couple of seconds and then keep going through the rest of the slides here.
I hope we have some with a whole bunch of positive outcomes.
Yes, that's what we like to see. All right, just a couple of seconds and then I'm going to advance the slide. All right, let's take a look at the results quickly. Okay, so 40% have never been audited. I think maybe keyword there is yet. Always good to stay on top of it and make sure you're prepared if and when they come knocking, but nice to see 40% have not been audited. 32% have with a positive outcome. About 16% have had a negative outcome from one, and then 11% are currently underway with an audit now. So hopefully some of the tips and tricks we're teaching you now will help you out with that. So thanks everyone, and we're gonna move into the next. Whoops, I think that's a repeat. There we go. Actionable steps.
So with our last few minutes, let's talk about some things that you can do before an auditor shows up. One, and I think we've hit on this pretty hard, which is understand your nexus obligations and how your products and services are taxable. I can't stress this next one enough, which is make sure that you've got exemption certificates on file. You can easily find them and that you're renewing them. So before an auditor comes in, maybe do an internal audit to see that you've got stuff. I used to do it every quarter. I would pick a plant and I would randomly sample them to see if I had certificates. But also consider automation to help you streamline all of these processes to remove the manual side of things. And why automate the sales tax management? Well, accuracy. If it's consistently the same process that's applying the rules, the rates, the boundaries, et cetera, it just becomes more accurate, and it's much more efficient that you're not waiting on somebody to do some research and having to call around. It's a much efficient process. Customer satisfaction, you're increasing customer satisfaction because your customers are being billed correctly. They're not having to call you and asking you to change the invoice. But it's also reducing your risk, because if you've got a repeatable process to apply common rates, rules, and boundaries, your risk of getting it wrong goes down as well. But it also helps you with your business growth. You can grow your business. You can acquire other businesses from using other ERPs by automating it with a common tax solution. And we've got some services that can certainly help you with all of those things. We think about having Avalara as the center of this world, both from a transaction tax on a sales side and on the purchase side. And we've got our core products, which are our tax calculation service, exemption services, and electronic invoicing and live reporting, which those electronic invoicing and live reporting outside the United States has really become a hot topic. And underneath that, we've enhanced all of those core services with things like license management, tax research tools, item classification if you're a convenience store and managing how things should be taxed, cross-border, and property tax. And then kind of the secret sauce is all of these integrations. If you've got a breadth of ways that you've gone to market and you need to be able to calculate tax, you need a solution that can do it in multiple fashions, whether that's through your accounting system, through your CRM, through e-commerce, grabbing marketplace transactions, especially for states like Washington and that B&O. Being able to capture accounts payable transactions for consumer use tax is important as well. And then lastly, there are professional services like Stephen's team that can help with voluntary disclosures. If you haven't collected and you should have, or you've collected and you haven't reported, they can certainly help with that. Doing risk assessments. We've got some risk assessments that are available to you that you can see where you should have been reporting and collecting and being able to quantify that for you. But we are also a certified service provider with the Streamlined Sales Tax Project. We can also help with implementing these solutions and supporting those solutions as well.
Fantastic. All right. Well, thank you both. We are right at the top of the hour. We might take a couple of minutes to answer some other questions, but one final poll question. If you would like a follow-up from an Avalara sales representatives to learn a little bit more about our services, even the professional services that Christine just talked about, go ahead and select yes from this poll question. And I'm going to leave this up for a minute while we dive into questions. But Stephen, I did want to maybe pass it back to you quickly. We had a lot of questions at the very beginning when we were talking about Nexus, especially as it related to physical Nexus. Is that something that the risk assessment that your team does, do you focus on physical Nexus?
Yes, absolutely. We focus on every possible way of Nexus for every single state. I just described this. It's a government sales tax audit on Nexus internally, though. That way we cover all the bases.
Awesome.
As well as determining any liabilities resulting of that, if there's any liabilities or not.
Yeah. Okay. So we do have a link. We offer both a free Nexus assessment as well as what Stephen's describing, which is more of the comprehensive paid version of it. But we do have a link for that in the additional resources section if you want to learn more about either one of those. Let me take a look through some of the other questions that we've gotten here. This one I thought was interesting. If we purchase items from out of state that are subject to use tax, do we have to pay use tax to our state? Is it at the state level or is it at a local jurisdiction level?
It depends. My answer for most things. It depends on the state. If there is a local use tax rate, then yes, you would have to pay both state and any of the applicable local rates as well.
Got it. Okay. Let's see. Oh, this was another one I thought that was interesting. So this person is saying that, and I think this is applicable to a lot of businesses, a business buys a license for a software, but they buy it for hundreds of employees that maybe are at different locations. What does that mean from a tax compliance perspective? How do they go about figuring out what rate they're charging and if it's the right rate?
That's that multiple points of use, right? Being able to apply tax based on where the benefit of those services are being received.
Right.
Okay. All right. Let's see. Oh, this is another one. So Stephen, you touched on this. Do you find that some states where you have physical nexus in, but your products aren't taxable in that state, what are the states saying? Do they still want you to register there? And is there anything with how the states will handle that, like a guide or anything like that, that they can look at to figure out state by state what to look at?
Sure. It depends on the state. California does not require, if you're a service provider strictly, you don't have to get registered, even if you have Nexus. Many of the states you do have to get registered despite your sales are 100% exempt. You still got to get registered. So, and then some states don't. So you go to the website, there's usually a section on when you're required to file, depending upon those set of circumstances. Websites have a lot of good information, or call anonymously.
Yep, great feedback. Okay. All right. Well, I did just want to make a couple of final reminders for everyone. So first of all, thank you for sticking with us. I know we went a couple of minutes long, but wanted to get to a few of your questions. We do have a record of all of the questions that come in, so we'll do our best to respond to those if we can. And for those of you who had said that they wanted to hear from an Avalara sales representative, we'll make sure that those calls are prioritized. Just a final reminder for CPE credit. If you qualified for CPE, so you responded to 3 out of the 4 poll questions and you attended for at least 50 minutes, you can go ahead and download your certificate now on the console. And then you will have a link back to this console and a link to your certificate individually in the follow-up email that we send out. So keep an eye out for that. Stephen and Christine, I really appreciate your time and staying on a few minutes later. Any final follow-up statements from either one of you?
No, I've covered it all. Hope to work with you at some point.
And
All
to
right.
Stephen's point, I think we covered an awful lot. It was great chatting with you. I hope you all took something out of this and can apply it to your business as well.
Yeah, absolutely. Thank you again, everyone, for attending. Keep an eye out for that follow-up email, and we'll see you for one of our future webinars very soon. Thanks, everyone.
Thank you.